to hedge with crypto options to maximize gains during Bitcoin uncertainty. This is the first part. So crypto options. So from basic to advanced strategies, there's something here for everyone. But before we dive in, here are two things about options you bet you didn't know. So options trading, as you know it today, can be traced back to the philosopher Aristotle, who detailed the first ever call option against an olive oil harvest in the 6th century BC. Stock options have become so popular that they are expected to overtake stock trading in volume by 2023. So now for the basics. So first and foremost, options contracts are derivatives. Essentially, this means they are tied to an underlying asset such as a stock, a commodity, or a cryptocurrency. So options always have an agreed upon price, known as the strike price, at which the buyer will gain long or short exposure to the underlying asset. They also have a predetermined date at which they expire, which is expiration date, and there are two types of options, which are the call options, is calls, and then put options is also known as the puts. A call option gives the buyer and seller long and short exposure above the strike price respectively. A put option gives the buyer and seller short and long exposure below the strike price respectively. As they are highly versatile, you can use puts and calls on their own or combine them to create complex option strategies. Ultimately, the end goal for all strategies is the same: to profit from market conditions. The option buyer, sometimes called the holder always pays a fee, which is option premium, to the seller or writer. This amount indicates the maximum amount of money the buyer can lose and the most the seller can profit from the particular trade. When trading options, there are three ways to describe a strike price. At the money, the underlying asset price is the same as the strike price. In the money describes a strike price in favorable position to the underlying asset. A call option is in the money when it's below the underlying, and a put option is in the money when it's above the underlying. So out of the money, when a strike is in an unfavorable position, a call option is out of the money above the underlying asset. A push option is below the underlying. So what is crypto options trading? Although they may sound complicated, options are one of the most common investment strategies for traders to hedge their existing positions and bet on the market's movement for returns. A crypto option is a contract that gives you the right to buy or sell an asset at a specific price within a given time frame or a particular expiration date, depending on the chosen type of contract. Crypto options trading is a term used to describe options contracts designed specifically for cryptocurrencies. For stock options, crypto options are booming. Like stock options, crypto options are booming as more retail traders turn to options as a hedging instrument amidst the bear market. Fundamentally, crypto options share the same characteristics as stock options, but they come with many more advantages. Unlike stock options, crypto options don't require you to buy or sell the underlying asset if an option expires in the money. Instead, your trading account will receive a credit or debit equal to the cash difference between the strike price and options settlement price. By removing the hassle of physical ownership, you can focus on what's truly important, which is making money. Why do futures traders diversify their portfolios with options to amplify returns? In 2021, options trading hit record levels of 62.58 billion contracts after numerous option wins made headlines across the globe. GME and AMC stock price surged and several Wall Street hedge funds opened sizable short positions in GME and AMC in anticipation of a drop in share prices. Retail traders rightly guess that if stocks move higher, institutions will be forced to buy back shares, pushing prices even higher. To take advantage of this, they bought far out of the money call options and paid small upfront premiums using leverage. Retail traders multiplied their buying power to gain access to a much larger volume of stock than if they bought it outright. As predicted, stocks roared higher with call options increasing in value exponentially and generating huge profits for retail traders. With this knowledge, futures traders now consider options a key component of their investment portfolios. Can crypto options really help to maximize gains? Once you've learned to use them to your advantage, crypto options really can help you maximize gains. Here are 3 ways to profit from options. Hedging to reduce market risks. Options are ideal for protecting an underlying portfolio against market risks and uncertainties. If you hold the underlying asset, a long put or put option spread are effective ways to hedge against a sell-off. If you are short on the underlying, a long call or call spread offers the same protection on the upside. The great thing about options is that you can choose an expiration date to protect your portfolio for 1 day or weeks or even months in the future. Leverage your capital. So with options, all you need is a little capital to potentially gain significant profits. When you buy an option, you can gain access to a large amount of the underlying asset for a small initial deposit. By using leverage, you can multiply the buying power of your capital several times over. So limited risk, unlimited upside. Every trader dreams of their very first 10-bagger. That's 1000% return of interest. Options are the perfect way to achieve it. All long options have limited risk and significant, sometimes unlimited profit potential. To illustrate this point, think back to the first crypto bull run of 2021. Some coins or tokens recorded growth of 10 to 20x with a small number skyrocketing to over 100 times their original value within just a few months. Now just imagine leveraging an options to take advantage of this price action, knowing the most you could lose is the premium and the sky is the limit when it comes to profit. Sounds good? That's the beauty of options for you. So how do crypto options work? So although crypto options behave like other options, they are more user friendly. What do you mean by this? So hold your horses, we will explain. So as Bybit's crypto options are cash settled, you realize your profits as soon as the option expires, allowing you to move on to the next opportunity without hesitation. This makes crypto options the perfect choice for speculating and hedging. Another benefit is that they don't have a fixed contract size, so you can risk as much or as little as you want. In addition, Bybit's crypto options are settled in USDC for security and flexibility. In the examples below, you will see how this works in practice. So the bull call spread, this is an illustration of how it looks like. So a bull call spread is an effective way to profit in a bull market without breaking the bank. The setup for the strategy involves buying a call option, usually out of the money, and selling a call at a higher strike price with the same expiration date. Since you are buying the strike closest to the underlying, the trade calls a net debit, which is the most you can lose. So here's an example of the bull call spread in action. So underlying BTC price of 30,000. So you buy one BTC at 31,000 call, costing $600. Then you sell one BTC 33,000 call, receiving a premium of $150. The trade costs a net debit of $450. Premium paid of $700 minus premium received of $150. So the break-even point is 31,450. Lower strike plus net debit. So the maximum potential profit of 1,550 occurs if the 33,000 call expires in the money. 33,000 minus 31,000 minus $450. So the worst case scenario is when the settlement price is at or below 31,000. Here both calls expire worthless and you lose the 450 net premium paid. So bear put spread. Okay, so the bear put spread is a mirror image of the bull call spread, offering a lower risk play for bear market profits. To set up the bear put spread, you buy a put option, usually out of the money, and sell a put at a lower strike with the same expiration date. Like the bull call spread, you are buying the strike closest to the underlying, so the trade costs a net debit. So for example, underlying BTC price of 30,000. So you buy one BTC at 29,000, put costing $600, and then you sell one BTC 27,000 put, receiving a premium of $150. The next cost is a net debit of $450, which is premium paid of $600 minus premium received of $150, which is also your maximum potential loss. The break-even point is 28,550. So higher strike minus $450 net debit. The max profit of 1,550 occurs if both strikes expire in the money. It's 29,000 minus 27,000 minus $450. The maximum potential loss occurs when both strikes expire out of the money with zero value. Here you lose your $450 investment. To call options are contracts that confer upon their owner the right but not the obligation to buy a specific amount of an underlying asset at a preset price on or before a certain date, known as the expiration date. And put options are contracts that confer upon the options buyer the right but not the obligation to sell a specific amount of an underlying asset at a preset price within a particular time frame.